All right, everyone, what's going on? Welcome to the channel. Today is Tuesday, September 20th, and in this video, we're going to touch on Bitcoin, Ethereum, XRP, believe it or not, a little bit of legacy, and then my plans and thoughts on tomorrow's FOMC. I'm also going to cover an order flow setup that I took advantage of yesterday, just to give you guys kind of an idea of how I use the footprint. This is a very textbook setup, low time frame setup, good entry, quick trade. And again, just a good example for you guys to learn from. Also, we will be joined by none other than trading legend Kim Kardashian during this video. And that is complete BS, but apparently YouTube favors you, or the algo favors you, if you mention someone noteworthy at the beginning of your recording. So we will be using that trick for the foreseeable future. All right, before we get into it, remember, none of this is financial advice. This is strictly for entertainment purposes only. The color I provide on markets is just my opinion, and that's it. Also, shout out to Phemex. Not only do they offer the lowest fees in the crypto market, over 100 spot and futures pairs, but now they actually have prediction markets. And I think this is awesome because it's really binary. The CME actually started this as well. So believe it or not, people can do a pretty decent job at anticipating where the market might be in the near future, but structuring a trade around that is the difficult part. Now, this is more than just with respect to assets. So as you can see on this front page, there is a market for the Fed decision. There's a market for, the US Open. So this is going to get really interesting. And if you want to sign up to Phemex, use the link below. So tradephemex.com. And they're currently running a bunch of different promotions, and that'll give you access to that. And it's a phenomenal exchange. Extremely trustworthy team. To me, that's the most important thing. They didn't stick their neck out there like a lot of other exchanges that we saw. And they've done the right thing, and they continue to. So I am a partner with them, and I think that's a phenomenal exchange, and they offer phenomenal product, honestly. It's the best execution across any crypto exchange that I've used. All right. So let's get into it. Okay, so we're going to talk about the S&P. So I have the ES chart, and most of you who follow me know by now that I chart the ES, right? It is the futures product. It is open outside of the normal cash session. So this is what I'm going to be sharing more often than not when I'm talking about the S&P. Bitcoin, Ethereum. Yes, we will talk about XRP. Believe it or not, it is somewhat relevant right now. I'm going to briefly touch on Apple because there is a point that is important to make with respect to this. My thoughts on leverage in the system, and then we will go over a little bit more of yesterday's trading debacle that I talked about. So I ended up on the day like $11, but I had some phenomenal trades. I gave back a good portion, got chopped up, but there's a really clean order flow setup that I want to point out to you guys because I think that it is a really useful training tool or learning tool or learning example. Who knows what I mean? Definitely wasn't what I first said. All right, so let's take a look at the ES. Training example, that's what I meant to say. So the ES, all right. Now, this is ugly. And it's ugly for a few reasons. Okay. Now, when markets bottom, it's very rare that you're going to have sort of a one-touch, V-shaped reversal, especially in this environment. So we're anticipating that the market's going to move sideways longer. That being said, there's some really clear areas where we want to see a response by bulls, by bears, and we just happen to have lost one of them. So this is really important, right? The ES or the S&P, or if you're looking at the NASDAQ or the Russell, these are really important because the correlation coefficient right now between Bitcoin, Ethereum, majors by proxy, is still really positive, right? So I think it was like 0.85 or 0.9, not 1, but it's a really strong positive correlation. So if the ES, the S&P, or if equity indices, if they get moving quickly to the downside, all correlations go to 1. Crypto dumps a lot more than the S&P. Crypto dumps a lot more than legacy. And I think it's really important to keep this in mind because we have lost a significant structural level, specifically in the S&P. So the level that I'm talking about, and in previous videos, we had gone over what we want to see for continued progress. And that would have been continuing to hold prior structural levels, right? Key contextual levels. More recently, the one that stands out is this level right here. So what we're looking at is right around 3,900. This is, again, the E-mini S&P. So just think about the S&P. It's the same, same level, right around 3,900. Now, this level is a weekly level. So we're looking back down at 1, 2, 3, 4, 5 weeks of market structure printed below this level, unable to claim that level. All right. This was the level that we retested on the way back down, found support at, and now we have lost it. Now, beyond just being a weekly level, and markets are actually trading really technically right now. So regardless of everything that's at play, macro wise, right, fundamentally, the markets are trading very technically. So similarly in crypto, when major levels are either gained or lost, we tend to see momentum begin to pick up and the market to really pile on behind either the regaining of a level or the loss of a level. So specifically, this weekly level also happens to be a value area high of a multi-week, month-plus long composite. So an area that was very accommodating of prices, so an area that was very balanced, where buyers and sellers were in relative agreement, where we were going from a highly kinetic period, or highly kinetic state to, we return back to finding our potential or building up potential energy, to bring this to some kind of physics example. And then exploded outside of that, had this, month plus long move, significant rally. And now we've fallen back within that structure. So this is 5 weeks long, very clear range that the market was in, very cleanly defined highs and lows. And what tends to happen is when you dig out or carve out these areas of market structure with these types of consolidations or bracketed market conditions or ranges, there's a lot of jargon in crypto, right? But it's all the same thing. When you carve this area out, when you reaccept back into it from either direction, and I think that things are probably going to get a little bit more slippery to the downside in this current market than to the upside. So in this case, we're reaccepting from the upside. So we're, it's a downward move. When we reaccept back within a structure like this, is a very significant chance or high probability that we just move from, point A to point B. So we fall back into that range-like behavior and find some kind of balance again back within a prior balanced area. It tends to be that case that, same thing on the low time frames and the high time frames, that when we have a very balanced area where buyers and sellers are in relative agreement, it kind of, like I gave this example before, if you imagine this structure as an area of balance, just flip that and imagine it like a carve out, right? So here is either the range high or range low. Imagine a little ridge here of resistance. And if you rolled an object toward that extreme, you might need a little bit extra to get it going. But once you tip it over the edge into that depression, it's going to sort of oscillate or rotate back within this as you would expect, right? And again, this is just, I think it's a helpful visualization, but the market reaccepting back below this weekly and prior composite level opens up a move back down to this 37 region. All right. The thing about this is a move like that is around, I believe, 5%. So if we look at from here to, let's just say 37, it's around, just 4.5% from today's price or this current price. A 4.5, we'll just say 5% move in the S&P tends to translate at least double in Bitcoin. So Bitcoin, actually, it's more like a beta of 3. We'll just agree on a 2.5. So if we have a 5% breakdown in the S&P, we're looking at like a 10% breakdown in BTC. And I think this is really important because this is the dog and BTC is the tail. Nothing has changed with respect to big moves in the S&P leading to big moves in BTC. The only thing that's happened more recently is we've had some short-term dislocations in the correlation, right? And these are so short-term and low time frame, that we would say that it's a spurious dislocation. Whereas previously people used to say the correlation was spurious. So we have these brief decouplings or decorrelations on the low time frames, and it's actually not in Bitcoin's favor. It's actually been the case that crypto has been weaker during times of the S&P rallying, and actually the times when the S&P drops and Bitcoin looks stronger, it's always a catch-up play. So if you see an example of the S&P continuing to make lows and you see BTC not making lows, don't kid yourself and think that, suddenly Bitcoin has found some kind of support that the S&P hasn't found yet. It's usually that it hasn't caught up yet. So I think this is the most important chart. It still is the most important indicator for crypto, because crypto is not trading like an inflation hedge. It's not trading like a store of value. It's trading like risk. So you could almost consider that crypto is trading like a tech stock. I've given this example many times before. I think one of the more important details to touch on with respect to the S&P is one of the largest, or actually largest component of the S&P, and that is Apple. Now, actually, Apple is closing towards its highs of the day, or rather, has closed near its highs. So this is a strong move by Apple, but Apple has been within a range on the weekly chart, putting in lower highs. And although Apple is strong, it's important to understand that Apple being the largest weighting, right, the largest weighted equity in the S&P, it's kind of like the Apple is holding up the S&P. So it's almost more ominous that Apple kind of moving sideways like this and not having broken down or broken out yet. If Apple breaks down, or if Apple begins to show signs of weakness, then that's going to ripple into the S&P, right? Or it's not going to ripple into it. It's actually going to translate to weakness in the S&P, because again, it is the largest index component by weighting. And I can't recall what the actual weighting is right now. I think it might be around 6% or 7%. But that's, I think, a really important detail, because weakness in Apple is going to translate to a weakness in the S&P just by proxy, because this is a component. So keep an eye on Apple. Keep an eye on, I would say, the top 10. So you're talking about like Apple, Microsoft, you have, Facebook, for example. You have to pay attention to the components of the S&P right now, right? Again, because if you didn't, you wouldn't know that basically the S&P is being carried by this pair right here. And I don't know enough about fundamentals to go into whether or not Apple is doing well, but I will say that they just released an iPhone 14 that doesn't seem like it's that different from the last iPhone. It seems like they've been doing a lot of that lately. And if anything, I would imagine that is an effort to continue to inflate the bottom line, right? To bring in capital. But again, on nothing that's really that groundbreaking. All right, so let's take a look at BTC. So a couple things. And in the pre-recorded content, I'm not really going to go to the low time frames, because at this point, whatever is recorded in this video would probably be stale if we're looking at like a tick chart or a 3-minute chart. So we're going to focus on the daily chart, the weekly chart, and then we have a 30-minute chart just to go over some more local activity. So first things first, the daily chart. One, I think it's important to just reiterate that none of this matters if the S&P puts in a multi-standard deviation move to the downside, right? Also, that being said, any level above, it probably applies the same way, but I don't think you're going to see the same response. Like if legacy finds footing, right, then I think that it's still a gradual response by crypto. Whereas if legacy loses its footing fast, there'll probably be an immediate response by crypto. All right. So we don't have like the best of both worlds right now. We're still, I think, open to faster punishment than faster reward. So this is a weekly chart. I think there's an important point to note with respect to this weekly chart. As far as our progress down, like it takes you 5 seconds to look at this chart and see that we're in a downtrend, right? If you look at more specifically the last couple of months, yes, we're within a range more locally. But as far as the primary trend goes, this is a downtrend, right? We broke out of market structure, this is like a year-long consolidation, right? Broke to the downside, have had our single leg, and now we've kind of just found support at prior all-time high at the 200, whatever you want to use. We're sitting above a gap. So, if the S&P was to continue to move down, that's another thing to be mindful of. This is an area where we did not spend much time at all. It's largely untested positioning. I think that's a really significant psychological pocket. And I think that's the first time I've ever used that phrase, psychological pocket. But this is kind of a pocket, right? It's one-way activity, untested positioning, right? We haven't been back down there in over 2 years. And accepting back within this like 17 to 13 region, it probably fills out the same way that any other low volume region would fill out. Again, I think that that's on the back of like any kind of larger move in the S&P. But just to point out, weekly levels in BTC, the loss of them on the daily has led to sustained moves down. So if we just look at the lows of this range more locally, or the lows of even this weekly level, single strong day closes through these levels, right? So here's our weekly level, right? That that was a multi-month, quarter-long consolidation. This was the first bottom that people thought we were making. Significant daily closes through that have not been buys, right? It hasn't been worth knife catching. And what you have to understand is just think about the psychology of participants within the structure. The longer it moves sideways, the longer people have to get committed on both sides. So when you actually do have commitment through one side, there's a lot more people built up to actually get rolled over, right? And now you've given everyone a clear signal that, okay, this consolidation has chosen a direction now. So you're more than likely going to see balance lead to imbalance. And again, high time frame trumps low time frame. High time frame evidence tends to lead to high time frame results, right? So a break out of a structure like this, while you have micro breaks in a low time frame, a larger daily commitment has led to sustained moves down more locally. Same thing here. This is another weekly level. The first weekly level that we created, it was very brief. The first case where we actually had a green week, this little pivot right here, daily close through that, right? So significant daily close through that level. Again, it's not closed out until around here. This first significant close down, and then through into these wicks led to a much larger move. I think that point that I'm trying to make right now is these wicks, these regions right here, these are not buys. So what you're doing very simply is you're looking at structures that were not accommodative of prices, right? It's a wick on a daily, right? So we could have spent a bunch of time there and then closed higher just the last couple seconds. But the point is, you got to think of it like excess if you're looking at a TPO chart, right? This is an area that gave a significant kickback. If you could come and just chill in that area, it's showing you that the same type of response is no longer there, right? Time, right? In this case, we had a lot of time to spend down here. And it's kind of like, imagine if you just drop the prices of iPhones right now, right? You're told, all right, there's a limited quantity of iPhones. They're $1,200 right now. We're going to drop them down to $500. All right, so you dropped it down to $500. Imagine if it just hung out there and no one took that supply. Well, I guess no one really wants it anymore, right? So normally you drop the price of something, you put it on a sale. And if you imagine that, these periods of balance are our auction and agreement, when you come to the low end of the structure, you're offering them a sale, right? It should be gobbled up right away. So accepting into these regions has been indicative of, again, commitment outside of the structure. And in the case of accepting down, much lower prices to come. So my point is, we've done this now, tested this region multiple times. I don't like in this environment the idea of, this is a ton of absorption and this is a bottom forming just on that. I need to see either a ton of selling come in and get absorbed and prices continue to move higher, or, some kind of change in the macro, right? Which is not something we could lean on right now. Otherwise, if we start breaking down, and just to give you an idea, that's the weekly level, right? Again, the thesis is around, or the setup is around a strong daily close through this level. So strong daily close, you get a candle that now, we have one, two, 1, 2, 3, 4 significant responses at this level. If you start accepting into this wick, which we're kind of doing now, if we start hanging out into these lows, it's not a level that I would just look to blindly buy, honestly, right? Because again, it's showing that whoever was there previously is allowing this thing to hang out lower much longer, when the reality is your dips in price should be bought up right away. If you could do this and hang out down here, the longer you spend down there, right, the more opportunity people have to take advantage of those prices, right? Time regulates all opportunities. And it would mean to me that something is amiss. Okay. So that line happens to be, I think I want to call this excess, right? That original daily, or these 2 days. And if you look back at the TPO, you would see what it looks like. There's a long tail. We'll just go to the 30-minute chart. Back out. Okay, this is the very swift response we had at the lows, right? There's not much of a tail, actually. It's just that happens to be an obviously strong kickback. If we're able to accept back into that, I don't know. Not a good sign. Pretty ominous. So want to stay above, ideally you want to stay above like 18, I think. I don't think you really want to see, what the market has at 17.5 again. So any kind of drift lower, in my opinion, is I don't know, cause for alarm, right? If you get a swift response, whatever. But I think I honestly would be willing to sell presence down here, right? If we're going to close a daily like this and then you have one day where everyone's kind of wondering, I think I'd rather just blindly sell that and say my invalidation is back above these lows. So no cause for concern yet, though. We're kind of flirting with the level, but again, mindful of the S&P kind of leading us more locally. Okay. Or I think it's probably important to talk about something real quick before we get into this local chart. A lot of people talk about leverage in crypto, and after this big move, there being none left. I think you could almost always assume that leverage in this market is on the long side. It's just way too obvious that the market is always looking for the long. The market aggressively shorts into some pockets, but usually that gets taken care of pretty quickly. When markets move sideways and build a range, absent any kind of major divergence in order flow or CVD or price action versus, the actual, open interest, I always assume that if the market's just moving sideways and open interest is going up, that it's longs kind of walking in. And we've seen this happen many times before. And the market more recently, for example, had sort of this sideways structure. Open interest is going up. People are thinking that this is shorts building or hedges building. And turned out that it was actually just a bunch of longs getting involved. And we actually know who was getting involved now. RIP Sue, right? But I think it's kind of the same thing can happen here, especially when you consider how low these prices are, what level they're at. I don't think that it's a ton of hedging at these low prices. I don't think it's directional shorts. I think there's a significant chance that there's a bunch of longs that got involved here and have been walking in, assuming that this is possibly a generational bottom. So any kind of large, sharp move down, I think would get them puking pretty quickly. So I think the point that I just wanted to reiterate is I think it's a good heuristic that when you see leverage, or open interest is what I'm using to refer to leverage, building up, when you see contracts building up and prices just kind of drifting sideways, I think it's safe to assume that most of the leverage in this market is just best assumed to be on the long side. Again, unless there's any clear signs in open interest and basis, looking at funding, to really show you that the lows were hammered with this open interest increase and then prices recovered. But we don't have that yet. We have just kind of hanging out at the lows. And I think it still validates my Q4 bottom tick thesis, where the bottoming process has started, but in Q4 that we get a lower move. So if that wasn't clear, check that tweet out. Q4 lower move means a lower tick than what we already have, right? So we haven't bottom ticked yet. Could change my mind, right? Locally though, we're going to go over a setup that I took yesterday, but this almost looked like it was an attractive reacceptance back into a multi-day composite. And it's kind of like the argument I was making for the S&P accepting back within its multi-month structure. The same kind of thing applies when you have balance form over a multi-day range or multi-week range. In this case, it was just under a week, but it was a 5-day structure. A lot of the times when the market, again, moves sideways like this, you have clean highs and lows being defended. You're building up positioning. If this does not lead to follow through, and this happened to be back into a daily level, so just to give you an idea of where that puked into, we'll zoom out. This is the daily, and we puked into this low, right? So we puked right into that low, had a brief stop, puked lower, and then had this under over, and that happens to be where I was looking for the order flow setup initially. This is actually my second trade. But this failure to continue, a lot of the times, this gap is where you're going to see this failure really get shut down. So you have a market that is auctioning sideways. You have kind of this one-sided, a lot of times it leaves a double distribution structure, highly impulsive imbalance move out. There's a gap, right? A lot of times this is the best risk reward to get involved in the short side for continuation. Seeing price fail to reaccept back within the gap. Talked about this hundreds of times. Acceptance back within one of these gaps offers a very clear, it offers a very quick one-sided trade, I should say, right? Because there's a lot of unchallenged positioning. So if you don't have a failure, in this case, it was like right around 18.7. If you don't have a failure or absorption here and you start accepting back within the gap, 99 times out of 100, you're going to tag the other side of the gap. You're going to head back to the origin of this structure and clean up that positioning. And it's not like you have to clean it up or the market tries to do that. It's a combination of it, right? It's a combination of knowing that there's untested positions there, people leaning on that, but then just the fact that they're there to begin with, like on the way down, people shorting into this hole. There's no clear invalidation for them. So a lot of times when the market reverses back into one of these gaps, just think of how you would think. You're thinking, I'm just going to close out, like whatever. So you got a bunch of that occurring in the same region with not much structure in the way. It leads to a very sharp move. The order book kind of thins out, right? Allows for this kind of air pocket type of behavior. So this is kind of where you were looking for a reacceptance to value trade or reacceptance back within value trade. You have a 5-day composite. 19.5 for me was the level, right? So we had the first rejection there. Market accepted back above within the structure, and you should see this move very quickly. You should see that if you have, again, this is a balanced composite over the 5 days. If you move outside of the structure, absorb sellers down here, and then reaccept, most of the time, this is going to move pretty quickly to the other side. Sometimes you'll get a retest after that occurs. Sometimes this will continue to range within the structure. You'll get multiple, trades at the high and the low of this prior range, but it should happen pretty quickly. And it especially should happen after you reclaim a rejection. So for example, we're at the underside of the structure here, rejects, right? This is where I get long. I'll go over that setup in a second because we just recovered this entire gap again, retested a gap move again. So you had a gap move down, gap move up. It doesn't leave, when you pass through a gap, you're not usually going to go through it slowly. So if you create a gap down and then you accept back into that gap on the way up, you're going to create a gap up. If you just continue to test these gaps, you're going to fill them out and fold through pretty quickly. This one ends up being a little bit more choppy. So if you have multiple gaps over time, you will see that they begin to fill out a little bit more slowly. Price begins to find fair value and agreement a little bit more where it was very imbalanced and one-sided. So with this particular setup, you're back within the range. You failed the first time. After this kind of move, like most of the time, that's it. You reapproach a level where now there are defined stops. Now it's sending a bit more of a clear message. It's just the bulls doing their thing. Two, there's a sign of strength. So reaccepting back within the place where you failed, it never happened because we failed. But a lot of times this is your second chance, right? So I was getting long here. I got chopped up a couple times, and ended up getting rid of the gains that I made in these two moves. But this failed again. So now we have a backside retest of this structure. Doesn't look good, right? It doesn't look good, but there's two clear trades that I think are worth touching on for BTC right now. And we'll go to the TPO chart. One, that 19.5 level is still good. Like there's no reason why you shouldn't be willing to long a level if it's failed a couple times. If we reapproach it, you make a stronger argument for it, especially after building a higher low. So 19.5 level is strong just based on And I don't mean it's strong. It's a good risk reward level. Again, if we reaccept above that, you have two failures, you're recovering now. You're consolidating against resistance again at this point. So acceptance back within that value, prior value, probably leads to 20,200. So that's a long opportunity off of that. Another one is this day is finishing out as an inside day. So we have current day inside of a prior day. If we close out this structure, 19.6, 19.5 is your trigger anyway, right? To the downside, if we close the structure out, all right, so we filled out yesterday's value. So if we close through today's low after closing out, so we finish this session, and then tomorrow we start accepting through this low, it's going to open up and move back down to 18.2. So you have a setup from like 18.65, 18,650, a breakdown below today's low. So if we don't make a new low today, that is beyond this structure. So that takes you from here to here. Then you have an inside day setup that also happens to be a reacceptance back within value at the highs around 19.5, 19.6. So that's BTC. I want to go over that low time frame structure that I was talking about in the order flow setup specifically. So here is the gap. This is the kind of strength and price action and order flow, way that I'll use the footprint on the lower time frame. So here's the gap. Okay. Here is consolidation and reacceptance into that gap. Gives you another gappy one-sided move. Here's the failure at 19.5. And then we begin to chop back down through that level. So you have one test. Okay. Breaks down again. Another test. This is prior day's POC. All right. This is a high volume region. And this is obviously it's an SR flip, right? Now we've covered the gap, failed at the level that we were just talking about. And now we retraced, and we're looking for signs and price action. If you're looking for a long, you're looking for signs and price action, right? You're looking for strength and price action and some kind of change on the low time frames. This is where you have it, right? So this is kind of an under over trap setup. So you have the market that is on the way down. These are short moves though. There's no major slipperiness in these moves down back through the gap. You have sellers that try to take this lower after a breakdown. So clear market structure, sellers really hitting the bid, and now the market completely reverses. I talk a lot in my videos about sold then hold. This is what I'm talking about. You see the same thing on Bybit as you see on Binance. You have a level that sellers were really pounding, buyers pounding too. Finally, sellers take it lower, but we have a complete reversal. Now we have more selling that comes in. So a lot more sold, big wipe and open interest. But for that amount of volume, there was less of an impact on price or even moving price down at all. Instead, what happens is you have this little low time frame flip of structure. So consolidation, trap, reversal, and now this high is now acting as support. Meanwhile, you couldn't find any support whenever sellers hit the bid prior. So you have more volume coming in. Now we're ticking higher. More selling coming in. Now we're ticking higher. So this is just a quick reversal on low time frame price action. And this is a lot of what I look for, honestly, when I'm looking for price action to confirm a setup. So it's an under over though, right? Because you have, again, brief consolidation, breakdown, brief consolidation. Looks like it might be a further breakdown. So this is kind of like a flag. Should give you a one-to-one move, right? Or a complete reversal. And instead, now the market rips up and is retesting the top side of that structure. So a lot of times we talk about under over setups for the high time frame, right? So if we were talking about the high time frame, it would be basically be us reclaiming this range that we were just talking about. So if we reclaim this range, the structure right here, the strongest sign from bulls we could get would definitely not be this, right? This is the weakest example you could have for a move back to the structure, which would be a failure, right? It's kind of clear. But if you had a rip through holding the top side of the structure, that's as strong as it gets, right? That's your under over. Breakdown, consolidation, breakdown, failure, reclaim, finding support at the top side of the structure. It makes more sense if you think about all that went into this move down here and nothing that it led to, right? Buyers coming in, not able to break outside the structure. Sellers coming in, not able to break it down. Finally, sellers break down. So if price can come back up here and you see a bunch of selling come in, but now we're able to move higher in the face of that, it shows you that there's been a shift in control. So low time frames, high time frame, obviously it's going to imply different the move will be different in terms of length or magnitude. But nevertheless, it's a very basic setup, and it was very clean yesterday on the footprint. So ETH is technically more attractive than BTC. So we're looking at, and the same thing with ETH as with BTC on the weekly and the daily. So we want to see that ETH holds this, 10,082 level. We're a ways away from it compared to where Bitcoin is, right? So again, ETH has been stronger. ETH has been technically better. We're more elevated from the merge, right? Which clearly is in the rear view now. But we've just more recently lost this local pivot. It happens to be, though, there's a good amount of confluence between that local pivot and prior range highs of a very clean consolidation down here that goes back to June and July. That being said, this is kind of like the S&P structure, right? It's like the S&P structure. It's a shorter time frame, though. It is cleaner. But if we even so much as get more of a push down into these lows, right, into yesterday's lows, you're more likely just going to cover that range, right? So that's one thing I would be mindful of. This is the best risk reward for longs on the daily right now. But it becomes a matter of, do you want to long this if it's going to hang out here? Or would you rather long it if we reclaimed a more local low, right? If it looks like we're about to be potentially be putting in a higher low. Still, I think that it's important to understand that this is probably not going to do anything anymore without BTC. Again, they're both following the S&P. ETH does no longer, has the merge to look forward to. That's behind us now. Sipping my coffee. I don't think I'll edit that one out either. But technically, this has been cleaner. Again, this low volume region is a region you want to see us reject out of, this sort of 1290 area. Otherwise, accepting back within this range is just going to lead to the same behavior that, again, we would see on the low time frames that we see on the high time frames as well. You're falling back into a range that's very accommodative. You're probably just going to lead to more ranging behavior, at a minimum, a test of those lows. I personally think that absent a very positive response tomorrow, that markets look like, the S&P looks like it wants to retest the lows. And I think that it was understood that it should have been anticipated that was going to happen, or that would be highly likely scenario, given that there's no real catalyst for a V-shaped reversal right now. So that being said, I think that you should prepare for downside in crypto, and there's always coins to be sold. So just, I think it's, to get the idea out of your head that there's no more supply. Now that we've moved sideways long enough, there definitely is supply. There are definitely people that are holding that would probably respond very negatively if we continue to push lower. So that is that. XRP is the last thing I want to cover. This is really simple. XRP has sort of this W bottom, broke out of this weekly structure. So weekly highest close for the last couple months. And honestly, this kind of thing is not something I would buy on its own, because this will probably not continue to move absent any kind of support by BTC and ETH, which need to be supported by legacy. But that being said, if we're going to find support, this 38 level is the level we want to see hold. So a daily hold of this level, daily pullback to that level, offers good risk reward to what I think would be a move back up to 45. The idea is, this is a very, again, accommodative range. Price flagged out, broke down, ranged again. And really, you could look at this as one big range. This is the mean, or the middle. And finding support here might offer us a move back to these highs. I wouldn't get my hopes up too much. It is interesting, though, because XRP is, it's XRP. But that covers it. I think that's everything I wanted to touch on. As far as FOMC, I've talked about my setups, or how I traded these events, whether it's FOMC, CPI, non-farm payroll. Last CPI was a bit different. It caught me off guard. I could have traded it better. I'm not really sure what to expect tomorrow. So no one has an edge in the FOMC. Most people think we're going to get 75 basis points. If we get 100 basis points, I'm going to propose two things to you. One, it's probably going to be a very ugly first move down. So algos are probably going to sell immediately, but it's possible for the market to respond positively in the coming week or two after, because it might be looked at as, okay, the Fed just threw the book at the market. Now maybe we're looking at 25 basis points going into the end of the year. If it's 75 basis points, I don't know. It feels like Groundhog Day. It feels like more of just the same. I will look to, again, join the first move. So for a predetermined amount. So for example, here's the FOMC, right? I'm going to give you an example of how I would play this. Here's the rate decision, this green line. Well, we're going to make this blue. We'll make it a little bit darker. That's the rate decision. All right. What I'm doing with this is I will just put on this percentage indicator. Okay. What I'm doing with this is just looking at, where are we? Where's the tool? Ah, come on. I will just manually put it in. Well, let's try that again. Okay, percentage. All right, there we go. What I'm doing is taking this. You could do this manually. You don't have to use a tool. 1, 3, 5, 10. Sometimes I change those, but the idea is I want to join the first move. If the first move, if I could get involved before it's moved 0.5%, I'm happy. So mark it in with the first move if it's still available. And I'm taking profit 99 times out of 100 by a 2% move. So if we hit tomorrow and we're here, I'm long already. Right? I'm hoping I'm long already. I've been very successful at this trade for the last year, but the last CPI I was not. I got kicked in the teeth. So if I could get in before we hit that 50 basis point threshold, I'm happy. There's a lot of slip. I'm trading with less size, but I'm getting out at a predetermined level. And depending on my feelings tomorrow, listen, sometimes you get lucky. It gets away from us or away from me a little faster. But if we're above 1.5, 2%, I'm getting out of the position very quickly. And then I'm looking to take advantage of the slingshot back in the opposite direction. CPI moved a lot more violently because there was a lot more longing into the event. This is a pretty flat movement into an event. Slight drift down, if anything. No major increase in open interest. So I don't know. Could be more hedging. Could be more shorting. It could be the long side that is, that might move a little bit more violently. But I think it's important to reiterate. If it's 75 basis points, I'm looking to join the first move as fast as possible and take advantage of the larger second move. So if we get 75 basis points, I don't know what the market's going to do. Maybe it dumps first, maybe it rips first. Either way, I expect the first move to be fake. Right? I expect the first move to be false. Might take 15, 20, 30 minutes before we get the reversal. Anywhere between 30 minutes to an hour is typical. And then you get a much larger move because you have a bunch of new fresh positioning that's joined something now, anticipating more follow through. So again, mechanical first trade. The second trade's more nuanced. It's a little bit more based on market structure and signs of momentum weakening and changes in order flow that are, I would say, very obvious I'm looking for. Otherwise, a lot of this is just based on price action. And that's that. I wish you guys luck. This has been my first pre-recorded content in a really long time. If you enjoyed this video, hit the like button. I will make sure to have chapters and leave a comment below. All right, guys. Until next time, good luck trading.